Let's wrap up this section by talking about the federal income tax system, and we need to talk about both individual taxes and corporate taxes. So both have a progressive structure, which means that the higher your income, the higher you're going to pay. Specifically, the higher the marginal tax rate. Remember that term marginal because it means the rate that's applied to the next unit. And so in this case, this is the tax rate that's applied to the next dollar in taxable income. So progressive structure for both corporate and personal taxes. And now let's talk specifically about corporate taxes for a moment. So they begin at 15%, they go up to 35% for corporations that have income over $10 million, but corporations in that $15 to $18 million range pay a marginal tax rate of 38%. Now, just because they paid all that in federal taxes doesn't mean they're done. They additionally have to pay state tax, which is around 5%. Now, individuals go up to 39.6%, but start as low as 10% if they have incomes over $400,000 for that highest rate. And they too might be subject to state tax. So now here's the sticky part. Interest. We're going to talk about this a lot. Interest payments by a corporation are tax deductible. So that's why in some cases, or up to a certain point, we like debt as a financing mechanism because we don't get that tax deduction on dividend payments that we make to shareholders. But that same tax deduction does not apply for individuals. You cannot deduct your interest payments on your credit cards and personal loans. However, a big exception is home loans and in some cases even student loans. Now let's switch over to interest earned. Interest earned is usually fully taxable unless you're earning interest from a municipal bond, or what we call a muni. Then the last category we need to talk about is dividends paid. And I mentioned that already, but we just want to highlight this, that dividends paid are paid out of after-tax income. So again, there's no tax deduction for dividend payments to shareholders by the corporation. So now what about the other side of it? What if you receive a dividend? Most investors have to pay taxes on those dividends, so that's where the double taxation comes in, because the corporation pays the dividends out of after-tax income, so it's money that's already been taxed, and then the investor has to pay taxes on that income, that dividend income again. But if you're in a lower tax bracket, you don't have to pay taxes on the dividends. But it's kind of a funny thing. Most investors that are in that lower tax bracket aren't getting dividend income. It's typically the high income or high tax bracket payers that are getting dividend income. Single individuals over 400,000, couples making over 450, they're going to pay 20% on their dividends. So remember this when we start talking about capital structure later on and talking about preferences for dividends. High earners don't want dividend payments. They rather the company keep that money and plow it back into the firm because they don't want to have to pay dividends on those distributions. And so again, because the dividends are paid out of after-tax income and then the investor has to pay tax, that's 2 times that income from the corporation gets taxed, and that's why we call it double taxation. Now, what you also need to be aware of, because we've talked about double taxation a few times, there is such a thing as triple taxation. And so triple taxation comes in when the corporation receives a dividend payment because of its holding in another corporation, and then because those dividends are after tax, then that corporation makes dividend payments to its shareholders after paying taxes, and then those shareholders have to pay tax. So one corporation pays taxes, pays a dividend to another corporation, that corporation pays taxes on that income, and then they pay a dividend to their shareholders, and the shareholder pays taxes. So that's 3 times that taxes are paid on the same income. So just some other stuff. This will come up a few times also. Tax loss carry back and carry forward. Since incomes fluctuate, sometimes we have losses and sometimes we have gains, firms can carry losses back to offset their previous profits, or they can carry it forward to offset profits in the future. So we'll see this when we're taking a tax credit, because we'll go ahead and show it maybe in a pro forma statement as a tax credit. But the idea is that we could use that credit to offset profits in the future. Capital gains. So these are defined as profits from when we're selling assets that aren't part of our normal business. And so the rules on capital gains taxes is typically a big one in political races, or often talked about by politicians. How do we handle capital gains tax? For individuals, it's generally capital gains are generally taxed as ordinary income, depending on the holding period. So if it's a year or less, it's ordinary, but then there's a capital gains rate if they've held it for longer. And for corporations, it's a little bit different. Most taxpayers pay about 15% on long-term capital gains. But again, if you're in that high income bracket, it could be as much as 20%.